Welcome to our webinar series today in partnership with Novel Capital. I am going to try to hold my tongue on the puns with Novel Capital, but they're a great partner and we're excited to have them. We're discussing today the nitty-gritty of non-dilutive financing, specifically revenue-based financing. And so to have a great conversation about that, we've brought Keith Harrington from Novel, who's one of the co-founders, as well as Tim Mahari, who is our head of investor platform here at Hum Capital. He's the one who spends the most time with our capital providers on our platform. Before we begin the proper content of the webinar, this is not investment advice. Please don't take it as such. This is just a conversation that we hope you will find very interesting. And while we do have some slides prepared for the visually oriented among you, feel free to ask questions. The Q&A chat is open, and I will make sure to get to every question that we possibly can. And with that preamble, Keith, we welcome you. And before we dig into any details on financing, can you tell us more about yourself and tell us more about Novel Capital?
Yeah, happy to. First of all, thank you so much for having me. I'm excited to be here to share a little bit more about revenue-based financing and about Novel Capital and what we do to help companies grow. We at Novel Capital have been at it in the revenue-based financing market for a few years now. I come to revenue-based financing with a background as a venture capitalist, so I'm a former VC. I was on the dark side, as some people say. And my co-founder, Carlos, was an entrepreneur in the ed tech market. So we teamed up a few years ago after seeing that there was an enormous opportunity to provide meaningful capital to entrepreneurs out in the market who either weren't a great fit for venture or weren't looking for dilutive capital at this particular point in their journey. And once we launched Novel a few years ago, we started to see real demand start to take hold. And we've been really excited about the journey so far. And I'm excited to share a little bit more today about what we do and how we do it.
Good. That's great. Tim, I want to hand time over to you to really lead this conversation with Keith. And I think we're going to start at a high level and then progressively drill down into specifics. And we'll have some slides, as I mentioned, but it's over to you, Tim, to carry us forward.
Thanks, Michael. Yeah, would love to dig in more. I know Keith has prepared some slides that we can run through here. Keith, I know since you mentioned a bit of a background of Novel Capital and where you sit, I think it'd be helpful to just take a quick step back and kind of understand what are all the capital options out there for companies to raise. Both the traditional options, alternative options, and where kind of those Novel's RBF options sit.
Yeah, so there are a bunch of options out there, and most people are familiar with them. First of all, entrepreneurs could go out and raise traditional debt from a bank or a similar lender. But in doing so, they'll likely have to deal with personal guarantees. They may have to put up personal security on their asset in order to get a loan. So we've seen entrepreneurs not only have to provide personal guarantees to the bank, but also have to provide their house as collateral, which is kind of a bummer. And in many cases, we fund software businesses. Banks don't really understand software businesses. They really have a hard time providing a meaningful amount of capital to those kinds of businesses. And you'll always, with a bank, you're going to have transaction fees, legal fees, unused credit fees if you've got a line of credit. So it's a really challenging form of capital for software entrepreneurs to actually get. Now the upside is it can be very, very cheap, just hard to get. Entrepreneurs also have the option of venture debt, which typically requires a pretty recent raise of a meaningful amount of equity capital. So, if you are an entrepreneur who has VC backing, in many cases you might be able to get venture debt, but it will likely have pretty restrictive covenants. It will likely come with warrants, meaning that lender will have an option on equity in your business. And so, again, it has an upside in that it is you'll have a lower interest rate and pretty sizable amount of capital in some cases, but it's really tough to get, and it really requires that you've got a VC sort of guaranteeing the debt on your behalf. And then, of course, everybody knows about venture capital, where you have the opportunity to create and then consistently evolve your pitch deck over the course of 6 to 12 months while you pitch every VC you can find. And you pitch them the opportunity to buy a portion of your company. So you always get diluted with VC, obviously. But it has a couple of pretty significant upsides. One, those check sizes are typically pretty large. And two, you don't have to repay it in the near term. It's really repaid at a liquidity event. The downside, obviously, is that it's tough to raise venture and it can be extraordinarily dilutive over time. And then there are some other forms of capital. Oh, sorry, I'm trying to find center here. And there it is. There are other forms of capital that a lot of people call alternative capital options. First and probably most familiar to most folks are online lenders, where you get the opportunity to raise usually a small amount of debt capital that ends up getting repaid by you to that lender, sometimes with daily repayments, sometimes with weekly repayments. Just kind of depends on the digital lender. What you find with these is that the cost of capital can be extraordinarily high, but the upside is they can provide it to you typically within a day. So I always caution entrepreneurs, if you need to take money in a day, then it might be time to just hit the brakes for a minute and figure out what's going wrong with your strategy. Because if you need money that fast, something might not be going quite the way you want it to, and you are in a suboptimal position when it comes to making a decision about capitalizing your business. It's really easy to make a bad decision when you've got your feet in the flames. Most people are also pretty familiar with crowdfunding, where you can raise money from sort of early supporters who are excited about your product. Recently, equity has become an option in crowdfunding, so you can actually raise a round that some folks call a community round of equity from supporters who really are excited about your product or your brand or your service. This is a pretty cool form of capital because it helps generate inbound leads and really connects you to the community of users and customers that your product or service really targets. And then, of course, close to my heart is revenue-based financing, which is it's not exactly new, but it has become more and more prevalent over the last couple of years. And with RBF, what you have is an opportunity to take money from a capital provider and then pay that capital back with a royalty or a revenue share over usually 3 to 5 years. And it's really great for companies with predictable revenue who are looking to invest in growth or to smooth their seasonal cash flows, like you might see in the ed tech market, because the payments go up and down based on your monthly revenue or your monthly cash collections.
Got it. Yeah, no, that makes sense. And thank you for that overview. I would say, a lot of the questions or feedback that I have from founders, there's a lot of options out there, as you kind of laid out for us. It can be a bit daunting as a founder. You have so many options out there. You have to make a decision with only one of them. What are the kind of key questions, if I'm a founder, that I should be asking myself to kind of make that best decision and choose the right capital for me?
Yeah, that's a great question. It's a critical question. First and foremost, the way that I think about it is when I'm talking to entrepreneurs, I urge them to think through what is the use of the capital that you're trying to raise, and then how do you make sure that you match that use to the structure of the capital that you do raise. So if you need a long period of time to pay that capital back, then you need to make sure that that capital matches your long or short time frame, if that's in fact the case. But you have to be very careful about matching the capital to your actual needs. And one of the things that's really tough about being an entrepreneur is nobody's going to do that for you. You have to do the work to figure out, what do I really need, and make sure that that's the kind of capital that you're really targeting. Once you understand what kind of capital is really best for you at this moment in your journey, then you have to figure out where can you get it in one, hopefully one fell swoop, right? You want a meaningful amount of capital. You don't want to have to cobble it together. Once you decide what you want, whether it's equity or revenue-based financing or whatever, you want to get it from one source, not a whole bunch of sources where you're kind of going around and, and trying to cobble together a meaningful amount. Once you've found the right provider, then I think what you really need to think about is, how does that provider continue to grow with you as you grow? Because if everything goes well, you're going to want more capital so that you can continue to grow your business. And if you are with a provider who's tapped out, then you have to go find a new partner. Maybe you have to refinance that partner. It just gets very complicated. So one of the things we always urge entrepreneurs to do is think over the long term and make sure that your partner is actually going to be able to provide capital for you over the long run. And then, of course, one of the things that you'll find in some markets is you have to pay for the money that you take, right? So if you take debt, any dollar that you take, you're going to have to pay interest on. So it becomes, there's a cost associated with every dollar that you take. So what we always urge entrepreneurs to think about is, what do you really need now versus 6 months from now versus a year from now? Just take what you need now so that you can use it, excuse me, and not pay on capital that you're not actually able to deploy yet. And so those are some of the things that we always urge entrepreneurs to be really careful about and think through when they're bringing on new capital for their business.
Right, makes sense. So thinking about down funnel, down the process, let's say I'm a founder, I've gone out to market, I've actually talked to some non-dilutive capital providers, I've got some offers on the table, and now I'm close to making a final decision. What are the kind of key considerations that I need to look at there when evaluating term sheets side by side? Are there typical gotchas in the fine print I need to be careful of? What are the terms and which ones should I kind of compare and optimize for?
Yeah, absolutely. So there are a couple of things that I think you have to be really careful about as an entrepreneur. First of all, a lot of non-dilutive capital comes with dilutive provisions. So, venture debt in and of itself is non-dilutive. But if there are warrants attached to it, then it can become dilutive for you, and actually it can become pretty expensive depending on how successful you are. So that 8% interest rate might look really good, but if you've given up a quarter point of your business and you sell your business for $1 billion, that debt got very, very expensive. So you want to be very, very cognizant of, are there warrants attached? What do you think the value of those warrants are going to be over time? Is there a success fee attached? Sometimes providers will call it instead of having warrants, they'll charge a success fee. So you sell the business for $100 million and they get a 1% of it maybe off the top. So you have to be careful about that. I would also urge entrepreneurs to be really careful to understand what are the covenants in any deal that is non-dilutive capital. Most of these deals come in the form of debt. So what do those covenants look like? What kind of rules do you have to follow? What kinds of issues do you think you might have to deal with going forward? In any kind of debt financing, you're going to find that there are downside protections for the lender. And you want to understand, what does that downside protection mean for you? Are they in the habit of throwing companies into bankruptcy? Are they in the habit of taking companies over when things go sideways? Look into that, have that conversation, really understand their strategy and their posture and their approach on those kinds of issues. And then finally, any capital that you take on is going to come with some measure of reporting, some measure of conversation and engagement with that capital provider. You're going to want to really understand, what's the tax there? Like how much reporting are you going to have to do? How hard is that going to be for you and for your team? And make sure that you are geared to provide whatever reporting that is. And that you have the data that they're looking for, and that just varies from provider to provider, as with all these things. Some providers are super light touch. Some providers require a bunch of engagement and a bunch of reporting, and you just want to spend time understanding what is it that you're getting into with any relationship, whether it's an equity or a debt provider.
Got it.
Keith, can I jump in and ask you a question? So a founder called me a couple weeks ago, and he said, I have three term sheets. Two of them are covenant covenant heavy, but a little bit cheaper. And
Yep.
one of them is no covenants, but more expensive. And I'm curious, how would you guide that founder through the trade-off? Because you can't really, like, I guess personal preference and a little bit of it depends plays into that, but there is some logic there to thinking through which deal you want to take.
You're exactly right. And that is the trade-off that you will see out in the market, right? More restrictive covenants means it's going to be cheaper for you as a founder. Less restrictive covenants means it's going to be more expensive. That's just how this market works. If I were talking to that founder, I would spend time understanding what are those covenants. Are you comfortable as a founder living with those covenants? And some of them are throwaway. Some of the covenants, you're never going to even have to worry about it, but some of them might be really important to understand. If you're a business, for example, let's just take an ed tech business. Ed tech businesses get paid like once or twice a year, right? That's just when ed tech customers pay their bills most often. And so if you're an ed tech business, you may have 3 or 4 months a year where you are super low on cash. And if you've taken a deal that says you have to maintain a minimum cash balance, and you know for a fact that you're going to struggle to keep that minimum cash balance, then I would in that case say maybe you opt for the slightly more expensive capital and do something that's going to be a little bit less restrictive. So it really depends on the business and, like you said, on the preference of the entrepreneur, because those covenants could be very, very restrictive. And they can change the way that you make decisions about your business. And that's not what you want. What you want is to be able to make decisions about your business that are the right decisions for your business, not the right decisions for your lender.
Do you think that lenders are always sophisticated enough to offer covenants that match the business? Or do you think that,
no,
an ed tech company, I guess it's kind of a leading, it's like a gimme
absolutely
question.
not.
But, I imagine that there's probably founders who think, well, it's cheaper, the covenants are a little bit heavier, and then they don't think about the fact that because of their payment cycle, they may get a huge crunch that they're not expecting.
That's exactly right. I don't think that most lenders think about that. Now, it's not because it's not out of malice or anything like that, or they're not good people. It's just, I think you have to really look at the business and understand the cyclical or the seasonal nature of it, and understand the industry and understand the business if you're going to design a bunch of covenants. And so one of the things that we've done over the last few years is really refined our list of covenants down to like the absolute bare minimum. Because at the end of the day, one of the things that we're really focused on is providing the entrepreneur the opportunity to make the decisions that are right for that business. And the way that we think about these businesses is, we're providing capital to businesses that are growing. They, in general, these are businesses that are growing, and they're growing in their niches. They've already figured out how to run a business. So we don't really need to teach them how to maintain a minimum cash balance or something like that. So, but it really does. It varies from lender to lender, how they think about that.
Awesome. So obviously at Novel Capital, you are specialized in revenue-based financing, and we knew we were going to talk about this during the webinar. So I know you prepared a few slides that break down what is revenue-based financing, why is it cool, what are the specific considerations there, and it would be great if you could talk about that. And then we can jump into some questions that have already come in from the audience and from that we knew we would want to talk about after that.
Yeah, of course. So RBF, revenue-based financing, is actually a pretty simple tool. It's been around for a little while, but it's been gaining a lot of popularity out in the market lately, which we're really happy about. But generally a company can get capital with a revenue-based financing deal in an amount, up to usually around 30% of their existing annual revenue. And then they pay that capital back up to a certain multiple through a revenue share, or through a percentage of monthly cash receipts. You can think of it like a royalty, actually. And that percentage is usually between 4 and 12%. And typically, depending on the life of the RBF deal, the length of the deal, that payback multiple could be anywhere from 1.15x if it's a 1-year deal to 1.75x if it's, for example, a 5-year deal. But it's a great structure for businesses that have, seasonal or variable cash flow, as we've talked about a couple of times, because the payments are smaller when your cash receipts are small, then the payment is naturally smaller, right? And in fact, if you have $0 in cash receipts from customers and you have a revenue-based financing deal, it could be that your payment is zero, because 4 to 12% of zero cash receipts is $0. So there's no minimum in some RBF deals. In our deals, we don't have a minimum. So you have a bad month, then so do we. So we're totally aligned with the entrepreneurs that we work with in that way. On the other side, if a company has a great month, then the payment can be commensurately large, which is great for everybody. So it's great for businesses that are trying to smooth out their cash flows and really invest in growth. And I think there's a slide that shows a little bit more about this. There, and then we could just go on to the next one. Yeah. So here's a pretty simple visual that I think kind of illustrates exactly how it works. So just hypothetical, made up numbers, made up company, but a company takes $300K from an RBF provider, and they commit to a 4.5% revenue share or royalty on their gross cash receipts every month. And they're going to pay their provider back 1.5x in 36 months. So that's those are the stats that you see across the bottom. So then let's say in April here, they have $200,000 of cash receipts. 4.5% of that 200K is $9,000. So that's the payment that they make. And then over time, over the life of that deal, over those 36 months, those payments, which are variable, add up to that 1.5x repayment. So very simple structure, pretty easy to understand. Totally different from normal debt, obviously, in that there's not a fixed payment that you have to figure out how to service in bad months, and generally totally aligned with how a company is doing month to month. So sounds like there are some questions, so we can jump into those if you'd like.
Well, I'd just like to start quickly. I know RBF is like very much a hot topic right now. It is marketed to an extent like everyone should take it, but you and I have had conversations about this, that there are times to take RBF. There are some people who may not be a perfect fit for it. We'd love to kind of jump into like, where's the real sweet spot? What is the perfect kind of use case for RBF, and in what situations maybe is it not a good fit?
Yeah, so we have a slide on this too, which gives a little bit of a quick summary. I think it's a great and important question, because what you don't want to do is take capital that doesn't make sense for your business. So, generally speaking, RBF really makes sense once a company has achieved product market fit and has some growth curve. So the way that we think about it at Novel is, if you have revenue growth of at least 20% year over year, you have predictable revenue, and you're managing your burn, and you're planning on using the capital to actually grow revenue, like directly grow revenue, then that's probably a pretty good fit for us. Before product market fit, that's angels and friends and family and VC. And then, once you get to the point where you're growing 100% year over year, or maybe venture is a good fit for you. But typically what we're looking for, and the way that we help companies, is we help them smooth seasonal cash flows, like in the example of the ed tech business that I mentioned. And it also helps as a bridge between funding rounds. So you're an entrepreneur, you're trying to build your business to your A round, perhaps trying to get to that next inflection point where you'll get a better valuation. Taking revenue-based financing beforehand that gives you the capital and therefore the resources you need in order to achieve those milestones is a great option. And in general, it's great for companies who are looking to hire sales and marketing resources and actually sort of increase the pace at which they're growing their company. But there are definitely, like you said, there are some times when it's definitely not a good idea to take revenue-based financing. If your growth is slowing or your company is declining, that's not a great time to take RBF, because the way that it works is you have to pay it back. That's the downside of RBF, right? You have to pay it back. And so if you're declining, then what that might set you up for is a really big balloon payment 3 years out or so. And that's not the position that you want to be in. And it's not a position that an RBF funder would want to put you in. So, if your business is declining and you're trying to figure out how to tilt the nose of the plane up, it's probably not a great time or opportunity for RBF. I would also not typically advise it as a way to refinance other debt. So, we've talked to a lot of companies who have some short-term debt on their books that they don't like because it's sort of the payments are punishingly high. There's just a point where there's not, it's difficult to refinance some of those existing debt out of a company's balance sheet. And then also adding to a company's debt load. So if a company already has a pretty significant amount of debt, adding RBF to it can create a situation where too much money is going out to lenders, too much money is coming out, and you can't allocate enough to growth. So we're really sensitive to making sure that when we are providing capital to a company, we're providing it in a way that's going to create enough space for that business to grow.
Here's a question for you.
Yeah.
So it makes sense, I think, why RBF is attractive to companies, the variable nature of it. It's a flexible facility you can bring onto your balance sheet. But can you talk about why it's so popular for capital providers? Like, I think it's kind of relatively easy to underwrite, and maybe you could shed some light on that.
Why it's so popular.
We know why demand likes it, but why do people like to supply revenue-based financing?
Right. I think it's because it's a way to provide growth capital to businesses on a going forward basis. So what's really interesting about revenue-based financing is once, for example, we have a relationship with a company, this is a very long-term relationship, right? Any deal that we do could be 3 to 5 years long. And that relationship continues to grow, and we continue to be a really significant portion of that, of any given company's capital stack. So I think the opportunity to be alongside a company that's growing and to continue to provide them capital in a way that allows them to continue to grow while also allowing, for example, my investors to be happy. That's a pretty great combination of things. And I'll point out that, when my co-founder and I, when Carlos and I started Novel a few years ago, there weren't that many of us. I'll use the pun. We were pretty novel at the time.
You just had
I had to. And for a lot of reasons, we certainly are novel and unique in the market. But I think there certainly has been an explosion of capital providers. And I think that's one of the things that entrepreneurs, as they look for revenue-based financing and as they talk to providers, really spend time kind of thinking through those items that I mentioned a few slides and a few minutes ago about how do you make the decision and what do you watch out for. I think that's a really important set of things to consider if you're a CEO looking for money, because not everything is the same and not every provider approaches amount, payback structure, covenants, interacting with a company when things are going sideways. Not everybody approaches these things the same way. And you really want to be really well informed about how your capital provider acts in those situations.
Awesome. So there's a few questions that have come in, and we can do this in a semi-rapid fire manner. So one question that came in is around early payback.
Mm-hmm.
How do you handle it? Is there a differentiation between different revenue-based financing, or is revenue-based financing in general pretty easy to just pay it all off and graduate into a different sort of facility of financing if you need to?
Yeah, it totally depends on the provider. Some providers will, in the hypothetical example that I shared before about, I think it was 1.5x in 36 months. If you get to the point where you're really growing fast, you're flush with cash and you want to pay it off, 12, 13 months in, they'll expect you to pay back the 1.5x. So it becomes, the money gets pretty expensive in that case. That's another one of those questions when you're talking to RBF providers, you're really going to want to understand how that works. Us in particular, we will prorate it. So, if it's, I'm going to make up numbers here, but let's say it was we would say 1.24x in 24 months. If you wanted to pay it off in 13 months, maybe it would be 1.13x. We would just prorate it so that so that the cost doesn't become exorbitant.
Awesome. What are the typical minimum MRRs or ARRs for revenue-based financing?
Yeah, that's a great question. And it, again, totally depends on the provider. Some will look at companies with $250,000 in revenue. Our approach is to fund companies that have between $500,000 and $10 million in annual revenue. And like I said before, 20% year-over-year growth. And then of course, some other metrics matter too. The important thing about revenue-based financing is that you have to have revenue before it actually works. So, and like I said, different providers require different revenue starting points. I think 500K is kind of the standard in the market today for the most part. And then there are much larger providers, much larger revenue-based financing providers that will look at a company once they've got, their entry point is 5 million in revenue, 10 million in revenue, 15 million in revenue, but smallest is about 250.
How real does the revenue have to be? That's not exactly how the question was phrased. The question was phrased as, do contracts count? And I think sometimes it's like, well, maybe by GAAP standards, it's not quite recognizable, but we're pretty confident this is coming in. Can you put that into an RBF and actually get funding from something like that?
Yeah, absolutely. As long as there's a base of revenue, that can absolutely work. And again, I think there are some of this is very situational. So, and depends on the provider. Some providers, they're just going to look at your trailing 12 revenue. So if it hasn't hit your P&L yet, then you're kind of out of luck and you're going to have to wait for that revenue to build. We look at both your P&L, but also your contracts. So you absolutely get credit for, if you sign a contract, that's revenue. As long as it's with a legitimate customer, then from our point of view that's revenue, and it counts for revenue-based financing. Again, depends on providers for sure.
How about revenue-based financing for reserves? In other words, we don't actually plan to spend this money. We just want to have access to it.
If you get a commitment from a revenue-based financing provider and you just want to have it on reserve, you will want to make sure that you are not having to pay for it, right? So if you, in many cases, an RBF provider will give you, let's say, a commitment for, let's keep the numbers easy, 100K. If you don't want to take it, then they're not going to do the deal with you. If you don't want to take it because you just want to have it on reserve, it can be, because it is a form of debt, it can be a little bit expensive to do it that way. So you'll want to make sure that your provider is comfortable with either a smaller amount up front and then tranches maybe going forward, which is one of the things that we do with a lot of the companies that we work with. But typically it's not usually going to work like a line of credit, which is kind of what that would sound like, right?
Mm. Is it appropriate to think of revenue-based financing in terms of principal and interest? And if so, how do I think about it that way?
Yeah, that's a good question. Yes, in that you are getting principal from a revenue-based financing provider and you're having to pay for it, which is interest. It's a little bit complicated to calculate interest, because the interest that you pay really depends on the speed at which you repay it. So if you pay, again, that hypothetical example that I shared, if you pay back 1.5x in 33 months rather than 36, then the interest rate that you've paid is a little bit higher than the 17% that it probably would have been. Right, it may be 16% because you paid it back a little bit more quickly than the term allowed. And so yes, but I would actually encourage entrepreneurs to think about it more in a gross sense. So if you're going to take 300K and you're going to pay 150K for it, which is what that hypothetical example was, are you going to be able to create more value than that $150,000 that you're paying for this money? And how quickly are you going to be able to create it, create that value? I think that's one of the ways that we've seen entrepreneurs think about it. Not really principal and interest, but more like, this is what this money costs. Can I create enough value to make it? Can I create enough value with this money that I'm getting more value than what the money costs?
Great. You're doing great, by the way. Full points for your rapid fire responses.
Oh, thank you.
Revenue-based financing versus recurring revenue facility. Are these apples to apples or apples to oranges?
Recurring revenue facility.
To be honest, it's not a term that I'm super familiar with either.
I wonder if is that like an MRR line of credit? It is going to be different. Okay, so I'll just take a stab at it.
Sure.
I'm going to guess, but I'll just be upfront about that. I'm guessing. I think the question is about like an MRR line of credit. That is a little bit different in that the money that if you have an MRR line of credit, let's say you get a $500,000 MRR line of credit, you take down 100,000 and then you start paying on it. It's going to flex up and down with your MRR, what they call a borrowing base every month, right? So it is entirely possible that your credit shrinks or that it goes up depending on a bunch of metrics that they're going to calculate. With revenue-based financing, really here's the amount of money and take it, use it, but your base doesn't shrink or expand. It's not really a line of credit. It's more like a more traditional loan with a term.
So I view revenue-based financing as, you had that sweet spot graph where like on your way to venture capital, you might want to think about RBF, but I think also on your way to like a large line of credit or, bank financing, you might want to think about RBF as well. And there's kind of this concept in my mind, at least, of graduating from RBF into a different source of financing. Is it one of those things that you just kind of, when like it starts to feel too expensive, you start to feel like you can get something better, and so then you go and explore that and you take it on? Or are there rules of thumb for when is the right time to quote unquote graduate out of this sort of financing structure?
Yeah, that's a really interesting question. And my answer today is different from what it would have been 2, maybe 3 years ago. Now, I think it's possible to actually continue a relationship with a revenue-based financing provider or establish a new one with a larger provider as you go. So if you take a revenue-based financing from us, for example, and let's say we commit $2 million, we help you grow for the next 36 months. And you get to month 36 and you're like, wow, that really worked. I do want cheaper capital now, though. At that point, we may very well say, well, it turns out we can commit $5 million per company. Why don't we talk about that? And as a company grows, for us, the capital becomes cheaper. I mean, for the company, our capital becomes cheaper as you grow. So as you generate more revenue and you therefore eliminate risk in the business, then capital gets cheaper and cheaper. And so 2 years ago, I would have said, once you need a $3 to $5 million check, I would say probably go somewhere else and, go to a venture bank or a bank that's comfortable with software companies. Today, I would say, pick a provider that can grow with you. And that can continue to grow as you do and adjust the cost of capital appropriately, which is how we approach it with the companies that we work with.
Awesome.
One thing stood out to me when you said that. Sorry, Michael, but you mentioned, what if we're in month 36? I think there is a prevailing consensus that RBFs are short term, that they are only 12 months. I know that's not actually always the case. We'd love for you to kind of touch a bit on that, since you guys. I know Novel does a bit longer terms, and I know that there are longer term RBF structures out there.
Yeah, that's also a really interesting question, and I think something that has happened in the market where there have been short-term revenue-based financing lenders that have come to the market, but those are typically really more in e-commerce, in the e-commerce market, where you can sort of very quickly turn money. In the software market and in other markets, because in my view, revenue-based financing works in a bunch of different markets. It really needs to be longer term. So it needs to be 36 months. It needs to be, in some cases, depending if it's a different kind of market, maybe even up to 60 months. And so we've heard a lot from entrepreneurs, we want our revenue-based financing, but we don't want it to be 12 months. And our point of view is, great. We don't actually want a year-long relationship anyway. We want to grow with you. We want to give you enough capital that you can grow. We want to grow with you, and we want to give you the time to grow into paying it back too. And so, there are certainly those 12-month deals out there. I would urge caution when contemplating a deal like that, because those shorter-term 12-month deals, a couple of things happen. The royalty rate goes from what I shared, 4 to 12% to sometimes 20 and above. And that's pretty tough to pay if you're going to pay it back in a year, or in some cases, just the terms of that particular deal are such that in any case, the payment's going to be high. So there's a minimum payment and there's revenue, there's the royalty. It's the minimum of royalty or a minimum payment. And it just puts you in a position where you're trying to pay back a lot of money really fast, which from my point of view is never great.
So we wanted to leave a few minutes for Tim. Tim has worked with a lot of companies and a lot of capital providers, and he can be the devil's advocate and poke holes. And so what we wanted to do is take the semi-theoretical that we've had and talk about a few stories, and then let you guys go through, almost a little bit of a what if scenario, like what if this had happened? Why did this happen? So I'll let Tim kind of guide us through that.
Yeah, no, I mean, we have a lot of, people come to us at Home Capital and ask about revenue-based financing and kind of give us their scenario and try and understand if it's a good fit and what are the options before or afterwards if they're not ready or if they think they want to graduate out of it. I'd love, Keith, if you have maybe a story or two of some customers that you worked with where it was a good fit, where the stories really aligned, and then, we'll see if I can stump you. Yeah,
I've got a couple of good examples. And here's hoping you don't stump me. I do this for a living after all. So I'll start with one that we funded, I think it was June of last year. It's a company that had a white label product for managing some of the back office of the unified communication space. They had product market fit. They're clearly onto something. They had a 1.5 million in ARR. They're growing at 50% year over year, but they couldn't grow faster. And the CEO really believed that they could. And so there are some things about this business that I thought were really interesting. First of all, this CEO, super smart, super driven, but he hadn't really ever been part of a fast growing startup before. And he's a first time CEO. And not only is he CEO, but he's running every single sale, right? So he's like finding the deals, negotiating the deals. He's very relationship driven. So it's not a quick process. And then closing every single deal that they close on his own. He had no salespeople. He's doing it all on his own. So he sees, there's demand in the market. If I could just replicate myself, then I'm going to be able to grow my company faster, but he didn't know how to do it. He was bootstrapped. He didn't want to raise any venture money. And because he hadn't been out and raised money before, he didn't really know how. So he came to us almost like super nervous about, I know I need to raise money, but I'm a little bit afraid to. And I know I don't want venture money. And I've heard about this revenue-based financing thing, tell me why this might work. And when we met him, he said, I want $1 million. I want $1 million. I need to hire 2 salespeople. We were like, well, you probably don't need $1 million. Whenever we meet with a company, we try to understand what is it exactly that you need, and let's configure it so that let's put a deal together that's going to work for you. And so he said he needed $1 million, and we said, well, let's talk that through. And what it came to was he needed to hire 2 salespeople now. And then he wanted to hire 2 more salespeople in 3 months and a few more salespeople after that. So what we suggested to him was, why don't you do 250K now, 250K in 3 months, and 250K 3 months after that. And as long as you're growing, we're going to continue to provide you the money. That's the business we're in, and that's what we want to do. And so he took it. And he took that first 250K, I think it was June of last year. Then he took the second tranche of 250K late summer, early fall. And then he took the final 250K just in the last, I think it was maybe 60 days. And he was able to bring on the salespeople and the marketing people that he needed. We are 9 months after our initial deal with him, and he's at $3 million in ARR. So he's doubled the size of his business in 9 months, right? Which he wouldn't have been able to do if he didn't take capital. And one of the other things that we helped him with was we helped him think through, what's your actual go-to-market strategy? We gave him a little bit of advice there and helped him think about how to hire the right kind of sales and marketing people. And so certainly wouldn't take credit for it, but being able to be there when he needed the right kind of money and a little bit of advice, I think really put him in a good position. And now, like I said, he's still bootstrapped. He is completely non-diluted and owns 100% of his business, and now at $3 million in ARR. And this guy's going to have a great exit at some point. He just keeps growing.
Yeah, no, that's a great story.
All right, poke a hole.
So, I mean, in that scenario, you managed to provide financing, and this company doubled their revenue, built out their sales team.
Yeah.
So that's kind of one trajectory, is they bring in this new capital, and that accelerates the growth really quickly. Let's say, you're obviously sometimes a long-term capital provider, as we kind of touched on earlier. Let's say, a year or two into the facility, a company is thinking the other way around. They don't want to accelerate growth. They're actually looking to move towards profitability. They're not quite there yet, but they think they can move towards break even. Yeah. And maybe growth isn't as fast as it was, but the unit economics look better. The profitability is kind of on the close horizon. What makes sense for them? Does it, how do you guys kind of work with borrowers at that stage in that decision?
Yeah, we love that. I think on one of the slides that we had up a few minutes ago, I mentioned that in revenue-based financing, you really like to see companies that are managing their burn, because at the end of the day, again, with revenue-based financing, you have to pay it back. So you want companies whose revenue growth is outpacing their expense growth. Those are the companies that really work well for this structure. So if he had made the decision to say, oh, I just want to get to profitability, that would have worked great for us. And in fact, this particular business is profitable and remains profitable, which in my view kind of makes him a bit of a unicorn. But those decisions the CEOs want to make, the CEOs will get to those kinds of points in the evolution of their business where they say, I can see profitability and that's where I want to get. That's great. We're always excited about that. That for us is, it's different when you're a venture capitalist. Venture capitalists will say, let's just bet it all and let's keep growing as fast as we can. But there's a point where the evolution of that business, the trajectory starts to point toward, let's get to sustainability, let's get to profitability. And that really works well for the companies that we work with.
Got it. And in that scenario, let's say, as they're kind of, the growth is maybe slowing down a little bit, and they're looking at other options to improve, as, organic growth may be slowing, maybe they start to look at inorganic growth options, acquisitions, or whether it be one large acquisition or several small bolt-ons. How does RBF work in that space? Is it a good fit? Is it not? And how would you work with the company that's kind of changing strategy, while they're still have a facility with you?
Yeah. So we've had that happen a couple of times where a company's growing and then they see an opportunity in the market and they decide, hey, let's be opportunistic and pick up, maybe it was a competitor or something that they can acquire and bolt on additional services and customers. We're totally supportive of that. What we typically do is sort of stand out of the way. And in some cases, we've actually provided a little bit of capital to help that help that acquisition actually happen. Sometimes it's not necessary. Other times the CEO will say, I'd like a little bit of extra capital and here's what I'm thinking, and we can help with that. So yeah, we're the way that we approach this is we really want to be flexible and supportive of the CEOs that we work with. So CEOs are going to make different decisions over time. Just because a CEO and a company is growing at X% today doesn't mean that that's going to be the case 6, 12, 18 months from now. And so we're in the business of being flexible and providing to the companies that we work with and the CEOs that we work with capital when they need it in the form that they need it. And so that's something that we focus on that every day. We try to make sure that we're giving them what it is that they need, and not being in a position where a lot of lenders end up where saying no to things that CEOs want to do.
Got it. Last question for me. If I was a business that kind of, I see a lot of this actually is that a company will come in and say that we actually have multiple revenue segments and they're quite different to each other. We have maybe a SaaS style segment. We have something that maybe is consumer facing. We hear a lot about recurring revenue financing, but only one part of our business, and maybe not the main part of our business, has that type of revenue model. Can I still get financing for that segment of the business, and how would a lender or capital provider look at that?
Yeah, so I can't speak for other capital providers, but I can tell you that when we look at a business like that, we know that there are very few businesses out there that are 100% recurring. Right. That is just, it's great when it happens, and kudos to the companies who can achieve that. But a lot of businesses have implementation fees and service fees and consultants who help implement their software or their SaaS product. And so we're totally comfortable with that. So, I think I said earlier, we typically will provide up to 30%. We'll fund up to 30% of a company's existing revenue stream, right? If that revenue stream isn't fully recurring, maybe we fund 20 or 25% instead. We just look at it as, yeah, it may not be fully recurring, but if there's a pattern to it and it appears to us to be predictable, we can still fund against it. And I would say, at least half of the companies in our portfolio probably match that description. Not everybody has 100% recurring revenue, that's for sure.
Makes sense. Yeah, that's it for me. 10 out of 10.
Thanks, Tim. Keith, I have a philosophical prophet seer question for you, which is, how do you see the space that you're in evolving over the next 5 years?
Oh, wow. Well, I think there's going to be more and more capital coming to this space, and I think entrepreneurs are going to continue to have more and more choices available to them. The really cool thing about this moment in the market is there's a lot of revenue-based financing now available, and you can go and you can look at different providers and say, this is the kind of company I want to work with. This is the kind of provider that I want to work with. I don't anticipate that that's going to stop anytime soon. I think that there are so many new providers in the market is a great testament to that this is not only a viable way to fund your business, but it's also a viable way for investors to get excited and to make money. And so I see this continuing to evolve. I see, more providers coming to the market. I think that will slow down a little bit, but I don't think the innovation in the market will slow down. I think entrepreneurs will continue to see more and more ways to fund their businesses, which is really what this is all about, right? Like, there shouldn't just be 2 or 3 ways to fund your business. You should have a ton of options and a ton of tools at your disposal. I think it's a really cool feature of the market today, that's kind of where we're headed.
Yes. And, totally shameless plug for Hum Capital, but the more complicated it gets, the harder it will be to find great partners like Novel Capital. So we're happy to be sitting there as a marketplace, connecting great companies to great capital providers. The last few minutes, Keith, how do people get in touch with you if they have specific questions, and anything else you want to say, in shameless advertising fashion for Novel Capital?
I just feel like I am a shameless advertising for Novel. You can see, I don't know if you can see it on my shirt. Yeah, so you can get a hold of me. It's actually really easy. You can email me at keith@novelcapital.com. It's spelled Keith, so spelled correctly, at novelcapital.com. You can also, just via our website, you can apply for funding. We have an online platform where we move pretty quickly through our process, because we know that entrepreneurs' time is incredibly valuable and, in fact, very scarce. So if you're interested in learning more, or in raising some capital for your business, and having a partner that's really committed to helping you grow, then please get in touch. We'd love to talk to you, and we'd love to provide you some money. But I think that's the easiest way to get in touch.
Great. Well, the burden falls on me to close out this really fun conversation. I honestly really enjoyed the Q&A. So thank you to the audience who asked great questions. We didn't even have to use our prepared for plug-in questions. So that speaks.
I know, I was tap dancing. That was great.
Yeah, that was really fun. Tim, thank you so much for guiding us through and being a hole puncher. And Keith, it was great to talk to you. And I think we only had 1 or 2 novel related puns. So our limit was 3. So I think we were successful here. Thanks everyone. And of course, slides will be available to you in the recap email that we send, and as well as the full recording. So thanks again, and have a great day, everyone. Bye.